Hello active traders, long time no see. Yes, you get it right. Today we'll be talking about America. The NFP or non-farm payroll is a measure of the number of jobs created or lost in the United States that belongs to the job report you have to know about when trading the financial markets. As it gauges the strength or weakness of employment in the United States, it is amongst the most watched economic indicators, as it can trigger short-term volatility on many assets and change longer-term trends. So let's dive right in and discover what the NFP report is. Published by the American Bureau of Labor Statistics the first Friday of each month at 8:30 a.m. Eastern Time, the job reports provides an exhaustive idea of the employment situation in the US. Taking into account almost 80% of the country's workforce, excluding farm and government workers, private households as well as non-profit employees, data on non-farm payrolls and the overall employment situation, the report provides extensive information on how well the US economy is doing and in what direction it is going. So which kind of information can you find in the employment report? 2 monthly surveys are used to create a comprehensive overview of the employment situation and future trends, the current population survey and the current employment statistics. As you can see, this report gives you relevant information about how many American jobs in the non-agricultural sector were created compared to the previous month, the industries that created or destroyed more jobs, the employment rate, and the wage growth, among other data. This information will help traders and investors better understand how the American Central Bank or the Fed will adopt its monetary policy and how it will impact the markets, which will in turn influence traders and investors' financial decisions. And that's why the NFP report is so important for traders and investors. So let's have a closer look at some of its components. As the employment report is quite long, most traders focus on 3 key measures. First is the headline figure, which is the number of jobs created or lost, the employment rate, and the hourly and weekly earnings. When it comes to a number of jobs created, the way to interpret the NFP report is pretty easy. If the NFP figure is positive, then it means that more people have a job and therefore more people receive a salary than the previous month, encouraging consumer spending. Remember that personal consumer spending is the main factor in US growth, as it accounts for more than 60% of the gross domestic product. Similarly, if employment increases, then it means that businesses face greater labor needs as they receive more orders and are more confident in the future of their business and the economy. As you might have guessed, if the report shows figures that are lower than the previous month, then it means that the US economy is somewhat weakening, and this can become very negative if it's a new trend. So if fewer people have a job, then it means that fewer people will receive a salary, and that globally less people will be ready to spend money. It could also mean that maybe companies are less confident in the future or they have less business needs to fulfill. Therefore, analyzing these reports helps traders and investors really understand how healthy the American economy is, what the overall direction of the US economy is, and most importantly, how this data can influence the Federal Open Markets Committee's decision about American monetary policy, which is one of the most significant market movers. If the Fed decides to increase or lower interest rates, then borrowing costs will be changed. This can change growth prospects, which will strongly impact the markets. So that is why you should closely follow these reports to try to anticipate Fed's move, rebalance your portfolio and take advantage of short-term opportunities. Well, hope this helps. If it doesn't, then I don't know what would. Now I'd be better off to work unless you don't want me to join the Bureau of Labor Statistics in the unemployment rate percentage section, right? Bye!